Good evening, everyone, and thank you for joining us. Welcome to Ironwood Wealth Management's Market Insight webinar for the second quarter of 2016. My name is Nick Basso, and I'm a portfolio administrator in Ironwood's investment division. Tonight, I am pleased to introduce our featured presenter, the Chief Investment Officer here at Ironwood, Mr. Steen Rogers. Steen is a charter holder of the Financial Analyst designation, and he also serves as Ironwood's primary investment strategist. If anyone has questions for Steen during the presentation, please feel free to type those into the chat box located inside the GoToWebinar panel on your screen. I'll compile the questions and we'll do our best to address them at the end of the presentation. And now, without further delay, please join me in welcoming Steen to lead this evening's presentation. Steen?
Thanks, Nick. And thanks, everyone, for joining us here on the call tonight on the Cinco de Mayo night. I'm glad everyone opted for Ironwood's quarterly market insight instead of Mexican beers, tequila, and chips. So thank you for joining. Hopefully we'll make the time worthwhile here. Well, last time we spoke was January 25th, and the markets were a little bit different than where they're at now. January 25th was about 10 trading days from the most recent stock market bottom. And so things have changed a lot when it comes to where stock prices are and where bond prices are since the last time we talked. So we're going to go ahead and talk about the global expansion and how it's been continuing, albeit very, very slowly. We're going to talk about central banks and interest rates, just like we always do. We're going to talk about two of the headwinds from 2014 and 2015, oil and energy prices and the U.S. dollar, and how those have changed a little bit in 2016. I kept the slide in here from our last talk, and so I just want to talk about it again because I think it's important what to look for in 2016 global recession. That's the slide I'm referring to. And then we want to make sure that we're sticking to blocking and tackling fundamentals of a prudent portfolio, and then we want to make sure that we learn from history. So those are the topics we're going to cover today. Expansion continues very, very slowly. 10-year Treasury rate at the end of the quarter was at 1.78%. It's actually right around there as of today. I had to update this slide a couple days ago, so it's actually a little bit lower than 1.8%. ISM manufacturing was 51.8 in March. It's the first reading that we've had above 50 in 6 months. April's number came out actually 2 days ago. That number was 50.8, so another number above 50. When you get numbers that are above 50, it means we're expanding. When you get numbers that are below 50, it means you're contracting. So the previous 6 months prior to March, the U.S. manufacturing sector was in contraction. Now, to make up for that, the U.S. is primarily about 80% service-oriented or manufacturing oriented versus about 20% manufacturing oriented. It wasn't always like that, but it shifted over the years to a more service-based economy. The ISM non-manufacturing PM number came in at 54.5, which is well above 50, but it's definitely a slower read than we've seen in the last 2 years. So it's the slowest reading we've seen in the last 24 months. Now it's for March. A couple days ago, we had April's number come out at 55.7, so a little bit better than the 54.5, much more in line with what we have been seeing over the last few months. So we definitely had a slowdown in March as far as service sector goes. And then U.S. economy, one of the strong points in the U.S. economy is still the job market, showing resiliency, and we'll talk a little bit more about that in a few slides. So here's this most recent expansion that we've seen down here. It is the 4th longest expansion when we're looking at time that we've ever seen. However, as you can see, GDP, cumulative real GDP since the prior peak is over here, and then time is over here. So yeah, it's the 4th longest, but we haven't gone nearly where the other expansions have gone. So there's a couple of comments that I want to make here. One, we really haven't overheated, and so a recession at these levels, it's possible, but it probably wouldn't be as detrimental as the last recession that we went through. So it's kind of the old adage, if you fall out of the basement, it's not going to hurt as much as if you fall off the 3rd story. So we could still have some solid growth ahead of us, and you know, we've been pretty choppy, and I still think that we'll probably see some earnings pickup with some of the headwinds that I'll talk about here in a little while subsiding. So you know, a lot of people are saying that this expansion is getting long in the tooth. It is, but we really haven't grown all that much, and so it wouldn't be unreasonable for us to continue to grow from these levels. Employment. So this is one of the bright spots, and the unemployment rate is at 5%. It stayed at 5% the last couple of jobs reports. We get a job report tomorrow, and we'll definitely want to keep our eye on that. The Fed will be keeping an eye on that, and in the more recent past, the jobs report has been a market mover because the market is looking at that jobs report and deciding, you know, is the Fed going to move earlier or later, depending on how that looks. Another thing that a lot of economists are looking at is wage growth, and so you're finally starting to see, and so 2.3%, and we're heading in the right direction here. 5% on the unemployment rate, and we're heading in the right direction. I'm going to go to the next slide because it's part of this conversation, which is the labor force participation rate. So as this unemployment rate has been coming down, a lot of folks out there complain about, well, yes, the unemployment rate's going down, but the labor force participation rate had also gone down tremendously over that period of time. So if you have less people in the labor force, then 5% doesn't really equate to 5% free recession. And they're right. And there's a large reason for that, and we'll get to that. One of the comments I do want to make is the government, the way that they calculate this unemployment rate, they've been doing it the same way since the 40s. So it's consistent. They've been doing it that same way since they started tracking the unemployment rate. So if we look at this participation, the biggest thing we see here is that people are getting older. And we have 10,000 people that are turning 65 every single day. And so you have a lot of people that are leaving the workforce because they're retiring. To add to that, we had a big recession, which hit a lot of people's retirement accounts. You know, maybe they were within 5 years of retiring, or maybe they wanted to retire, but then their accounts, you know, took a big hit. So they decided that they wouldn't be able to retire, and a lot of people were focused, and they put lots of money into their plans. And now, 2009 to 2016, you get a pretty good run-up in the stock market, and you look at those same retirement accounts, and people are saying, oh, you know what, I think I can retire now. And so that's why this biggest portion here of the labor force participation rate dropping is due to aging. The other is due to cyclical and other factors. So some of those cyclical and other factors are when you get to a point where the unemployment rate gets very low, like at 5% or close to full employment. What happens is early in the unemployment cycle, you get people who lose their jobs, who are looking for jobs. Maybe they're looking for a job for 6 months. They can't find a job. And so when the government calls and says, hey, are you looking for a job? After they've looked for 6 months, maybe they were saying, yeah, I'm looking for a job the first 6 months. But then that 7th month, the government calls and says, hey, are you looking for a job? And they might still be looking for a job, but they're just so despondent that they decide to say, no, I'm not really looking for a job. There's no jobs out there. And so they kind of give up, even though they might not really give up. They at least tell the government that they're not looking for a job. And so when you get to points where the unemployment gets close to full full employment, you start to see a reversing effect of that. You start to see the people who were despondent start to look for jobs again. And then when they get that same call, they say, yeah, I am looking for a job. And so that's one of the reasons that you see this participation rate peaking here and starting to go the correct way there. And then also another factor here is that the government has become a lot more harsh on disability claims. So that's another, if somebody goes on disability, they fall off out of the labor force. But if the government starts to get a little more harsh on those, and they get recounted. So that is definitely happening as well. Cyclical sectors, they definitely slowed down earlier this year, but they didn't fall off a cliff. I guess the first one I want to talk about is the auto sales. You can see it kind of slowed down. This is as of March, a couple days ago, yesterday actually. They came out with April's numbers. April's numbers were the best April we've ever had on history for auto sales. The annualized rate was 17.5 million. So you can see that, yeah, we had a little bit of a pullback beginning of the year, but we bounced right back up to not the all-time high, but the best April we've seen. Housing is definitely doing well. It's heading in the right direction. It didn't really even take a pause. Real capital goods orders, you can see we've definitely taken a pause. We're back down to averages, but we're not falling off a cliff by any means here. The one that does concern me is this inventories. And this is one of the reasons that the GDP number came in so soft at 0.5% for the first quarter. Now, there's been, the last few years, there's been a lot of noise in the first quarter GDP, so I wouldn't be surprised if that GDP number gets revised upward. It has over the last couple of years in the first quarter because of some seasonal effects. So we'll take a look at this, but this inventory elevation definitely gets my attention. So this is something that will be a headwind going forward because we'll have to get through this inventory before companies can start making more stuff, more new stuff. The silver lining. The silver lining is the consumer. And in the U.S., 2/3 of the U.S. economy is based on the consumer, roughly 2/3. Consumers are doing very, very well for the most part. Since the second quarter of 2007, so the last peak of net worth, we are up $20 trillion net worth-wise. So there's definitely a net worth effect, and it makes people feel better. And they tend to spend more money when they feel good about their net worth. You have the household debt service at very, very low levels. You have consumers paying off debt. You have asset prices going up. That's what this whole household net worth up 20 trillion is. You have oil prices that are very low. You know, you go fill up your tank, it's costing you 30% less to fill up your tank, roughly. So consumers are in a great position. The U.S. consumer, at least, is in a great position and is a bright spot for the U.S. economy. And we'll touch a little bit more about this later on in the presentation. International. So that was what we just went over was the domestic economy, the U.S. economy. So now we'll move to the rest of the world. And the rest of the world is about 4 years, 3 to 5 years behind the U.S. when it comes to recovery. A lot of central banks after the Great Recession, they eased monetary policy, but then they started tightening way too early. Whereas the Fed continued with easy money and quantitative easing much longer than a lot of other economies. And some of these international economies ended up going through double-dip recessions, and so they're kind of where we were 3 or 4 years ago. I don't know how well you guys can see this, but basically, if we look at the global ISM top manufacturing numbers, remember anything over 50 is expanding. So we look at the middle of last year, August, July, 50.8, 50.4, 50.4, 51, 51, you know, 50.7, 50.9, 50, 50.5. We're not growing like gangbusters. We were growing much faster in 2014. One of the reasons is emerging markets, and that was a big one, and we'll touch a little bit more about this in a couple of slides here. The summer of last year, when China had their scare, you can see manufacturing numbers went down. Not a ton, but they definitely went down. As of March, the number for emerging markets was above 50. So now we've got developed markets over 50, we've got the globe at 50, we've got emerging markets at over 50, and we've got the U.S. at 50. So these aren't great numbers. You know, we're not talking about you know, high mid 50s. We're just talking about barely over 50. So it's slow going throughout the globe. However, some of these economies are primed to do fairly well because of some of the recent events that have happened. So let's look at Europe for a second. Their market PMI numbers are improving. Their GDP growth is improving. Their unemployment is coming down. But realize they were 12% in 2013. They've gone to 10.3. You know, we're probably somewhere around 8% is where normal unemployment would be for Europe. So we've still got 2 percentage points of what I'll call tailwind, because that at every percentage point of unemployment improvement adds about 1% to GDP growth. So you've got 2% of pent-up employment that will add to the system. You've got stronger loan demand. So there are some areas in Europe that look like they could have some wind behind them. Japan does not look very exciting. They're slow growth. They've been slow growth. We've had a little bit of an increase in wage growth, but I mean, we're talking about from a negative 1% to just barely over 0. So Japan is a tough one, but it's been like that for, you know, almost 30 years now. So they do have some a new regime that is experimenting with some policies to try and revamp growth. We'll see how that goes. China is kind of where I'm a little more excited for future growth and future returns from the portfolio. China and really the emerging markets as a whole. And so last summer, China and some of the emerging markets definitely slowed down, and it had a huge impact. You know, when economies like China, who are the marginal consumer of stuff, end up slowing down, folks who are managing portfolios, they get worried, and they want to start selling assets that have anything to do with China slowing down tremendously. And so, you know, we had a 7.3% GDP growth in 2014, and that slowed down to 6.9% in 2015. So it's not like they're falling off of a cliff here. Here's a little bit better way to look at what happened last summer. You've got the services PMI and you've got the manufacturing PMI. So they both turned south in the middle of last year, pretty good. But you can see since then we've had a pretty good recovery, and they've done some monetary policy, they've done some governmental policy, some fiscal stuff with foreign exchange reserves. So they're doing things, and China's government, PBOC, is something that you don't really want to get in the way of. If they want to spend a bunch of money on stuff and fix some of their problems, they can easily do that. You can see their domestic auto sales ramped up recently. So China's not falling off of a cliff here, and this is one of the reasons. This China, and then also emerging markets in general, is one of the reasons that we've seen this recovery that we've seen, because it was based on, okay, China's going to slow down, maybe go into a recession, not a recession, but slow down, which is going to create the globe to go into a recession. Well, that's turned around here, and so now you're seeing that asset prices are not pricing in a global recession. Another thing with China is they're moving from a manufacturing-based economy to a services-based economy, just like the United States has done over many, many, many years. And it's going to be choppy. You're going to see things like this because they're making some big shifts. One thing to note is that China has about 20% of their population that is in the middle class. That number is going to go from 20 to 70 by 2030. They have over a billion people in China. So you're talking about 500 million people going from poverty to the middle class. So that is going to be a prime opportunity for growth. Behind China is India, and they've got a billion plus people, and they're just a little bit behind where China was. So there definitely some opportunities in the emerging markets, and we'll discuss a little bit more in a couple of slides. Central banks and interest rates. So this one's tough because we get into an aspect of interest rates which are just paying us absolutely nothing. If we look at government bonds throughout the world, 29% of government bonds, the blue ones, are paying you less than 0%. They have negative rates. 29% of government bonds throughout the world. That's astonishing. That's unprecedented. 66% of all bonds are paying you less than 1%. So it is very difficult to build a portfolio when you know you need to have some safe assets, when all of these safe assets are paying you less than 1%. Very difficult to build a portfolio. But you can see negative rates in Japan, negative rates in the Eurozone, the US and the UK, two of the countries that did not pause monetary policy right after the Great Recession, are doing the best. And we think that has a big reason, that was a big reason why. And now you see all of these other economies trying to copy what the U.S. and the U.K. did, which is quantitative easing, low interest rates, zero interest, negative interest rates. The U.S. didn't do that. The U.K. didn't do that, but easy monetary policy. And so I think that you're going to start to see some pretty decent growth out of some of these other countries. And that's also why you had the dollar appreciate as much as it has. And we'll talk about the dollar all on its own here in a few. So I won't get into that just yet. Interest rates forecast by the Fed. So this is after the March meeting. The Fed actually, after the December meeting, you could extrapolate what their expectations were, and they were expecting 4 rate hikes in 2016. When they came out with their March data, that had gotten knocked down to 2 hikes in 2016. And you can see that the blue line here is what the Fed thinks over the next couple of years. So at the end of 2016, they believe that the Fed funds rate will be at 0.88%. In 2017, at the end of 2017, it will be at 1.88%. And at the end of 2018, it'll be at 3%. The market, on the other hand, which has been more correct than the Fed, is much lower. We've got a end of 2018 that's almost 2% different than what the Fed is expecting. So the market has definitely been more right, because they've been betting this whole time that it's going to take the Fed a lot longer to increase interest rates back to where back to more normal levels. And the Fed has been saying, no, we're going to get back to normal levels quicker. And so that's had an impact on the yield curve. And here's the yield curve in gray as of December 31st, 2013. So something happened in the summer of 2013. Ben Bernanke came out and said, you know, we might taper the QE. And the bond market went through what's called a taper tantrum, or what's known as the taper tantrum. So December 31st, we were reflecting the taper tantrum. The 10-year Treasury was at 3%, believe it or not. You know, just less than 3 years ago, we were at a 3% 10-year Treasury. Now we're at 1.8. And you can also see that the yield curve, excuse me, was steeper. It's a lot better to be a bank in this steep environment, because you lend out at these rates, or I'm sorry, you give depositors very low interest rate, and you lend out at higher interest rates. Since then, because the Fed has come out more dovish over the last 2.5 years, you can see that this whole entire yield curve has shifted downward, and it's started to flatten. And so that is a reflection of what the market is expecting here. And rates are very, very low right now. I think the risk to fixed income is that the market ends up being wrong. We have better growth than what the market believes we're going to have. And somewhere in between the market and what the Fed expects is where interest rates end up going. Or, heaven forbid, the Fed does, you know, the Fed funds rate are these levels at the end of 2016, 2017, 2018. We'd have to see some major economic improvement in order for them to get to 3% by the end of 2018. I hope that we see it, but it's hard to see that we have that much growth in only 2.5 years. But it's not impossible. So what happens when the Fed starts to hike? And I kind of already alluded to this. The blue lines are prior to the hike, the first hike, and the gray lines are after the hike cycle is done. So we had the first hike. The first hike was done in December. But this is not a normal hike cycle. This is going to be a prolonged hike cycle. You can tell by the language from the Fed, this is going to take a long time. If you remember one of the very first graphs I showed was we're having slow growth. The recession, the financial crisis, and the Great Recession was a big one. You can see how much GDP we lost from the peak was greater than any of these other recessions. And it took us a lot longer to get back to where we made up for that. So with that said, you would expect monetary policy to be a little unprecedented. So I do think that it's going to take a little bit, and we've had 6-7 years of very, very low interest rates. But we had the first rate hike cycle, and we want to be aware of what's going to happen, what we think is going to happen with the bond market over the next couple of years. The bond market, in our estimation, is not going to be a place where we're going to see very much return, total return. You might earn 2 or 3% yield on some of your bonds, and you might lose 2 or 3% in principal because of the interest rate changes. So as interest rates increase, your bond principal goes down. So you might have a bond that's giving you, let's say, 3%, but then interest rates go up by 1% and you lose 3% on the principal, so you end up total return on your bond at 0. Okay? So that type of environment is what we believe is the most likely environment over the next couple of years in the bond market. Now, we've been saying this for a couple of years, and the bond market has actually, interest rates have actually gone down since the taper tantrum, which we definitely didn't expect. So it definitely can happen. You don't want to abandon bonds altogether, because if we do have slow growth, bonds are going to be basically your only return. So that's enough on the fixed income market there. Two of the big headwinds that had a lot to do with the profit recession that we've seen here in the U.S. are energy prices, and I'm gonna show energy by showing the oil markets and the U.S. dollar. Two of the biggest reasons that we've seen this profit recession that we've gone through. And oil, really, a lot of folks last summer thought it was more of a demand issue because of the China slowdown. But really, when we look at it, it's not really a demand issue. We still have growth in consumption. I mean, China's, over the last 3 years, their oil consumption's gone up 10%. Globally, oil consumption's gone up 4%. The issue is here in the supply. Supply has gone up 6% over that same period of time. Most of that is in the U.S. And it was due to technology, fracking, and being able to pull oil out of the ground where we didn't believe we would be able to pull oil out of. And so that's why you can see over the last 3 years, the U.S. has a 17% growth in oil production. Okay? But if we look at 2015, 2014, 2016, you can see that these are not huge inventory changes. We're talking about 2 million barrels a day into a market that does almost 100 million barrels a day. So you're talking maybe, 4 or 5% over 3 years of oil supply. That should not constitute a over 75% drop in oil prices. We got down to $26 a barrel in February. Now, oil's at about $44 as of today. And one of the reasons is you're starting to see supply and demand kind of work its way out. So what happens when you have a low price and a lot of supply, well, the price goes down. And you had the rig count at 2,000 back in 2015. It's gone down to 500. And you still have some supply issues. So supply is still going up, but eventually, because of these rig counts, and this is just looking at the U.S., we are going to eat into this supply, and you're going to start to see it come back down. And the market's already kind of predicting that with a $44 a barrel oil price. So let's just remember that for when I talk about the profit recession here in the next slide. The other headwind, and energy prices were definitely the biggest headwind, followed by the U.S. dollar. The U.S. dollar has been a headwind. U.S. companies that sell overseas are not as competitive, and then when they restate their earnings in U.S. dollars, they lose earnings when they restate, and they translate everything back into U.S. dollars. So it hurts earnings. Well, we've seen a reversal in the U.S. dollar appreciation, and so far in 2016, we've seen a U.S. dollar depreciation in line with a more dovish Fed. And so those two things kind of go hand in hand. And you saw the euro trading at, I think it got as low as $1.06, and as of today, it's at $1.14, $1.15. So you're starting to see the dollar stabilize, which is a very, very positive sign. So here's the earnings recession that I spoke of earlier. We had 5 quarters of declining earnings. 100%, more than 100% was due to the two things I just talked about, mostly from energy prices. And when I say energy prices, the energy sector, companies like Freeport-McMoRan, their asset prices get marked to market. And so you get stock prices that go down tremendously overnight, and you get earnings that get slashed in half, or go from positive to negative earnings overnight. There's a benefit to consumers, but the benefit takes a while because consumers see it every month at the pump, whereas the energy companies themselves have to mark things to market. So the asset prices get marked to market right away, and the benefit of lower oil prices is a tailwind over time. And lower oil prices should be net positive to all nations that are consumers of oil. And so most nations are consumers of oil. There's only a few that are net producers of oil. And so that should be a global tailwind, the lower oil prices. But immediately what happens is you see the earnings from anything that's related to materials or energy sector decline very quickly. And so the energy sector was responsible for over 100%, the energy sector and the U.S. dollar, over 100% of this profit recession. So now that oil prices are stabilizing and the dollar is stabilizing, we see earnings in the second half of this year improving tremendously. And so we see a very strong second half of this year, led by that silver lining that I talked about, that U.S. consumer. Another impact of energy prices we saw in the high yield market a couple of summers ago. The high yield spreads. So right here you can see high yield spread. What a high yield spread is, it's if we have a high yield bond and we compare it to the similar maturity treasury, the difference in those yields is the yield spread. So let's just, for an example, let's look at if we had a 10-year treasury right now, it'd be paying us 1.8%. Let's round up to 2. So it's paying us 2%. So if our spreads right now for high yield are 7.5, that means high yield bonds are paying us 9.5%. Okay? That spread a couple summers ago was 4.5. So 3 percentage points lower. The average is 5.9. We were very boisterous when those yield spreads were at 4.5. We did not like that. We did not think you were getting paid for the risk that you were taking. And lo and behold, oil prices slumped. A big portion of the high yield market is energy and materials. And so that has a huge impact on yield spreads. And so now we're at 7.5. Now you're starting to look at these things and say, okay, well now I'm getting paid a little bit commensurate with the risk that I'm taking here. So we do like high yield right now. But just to give you an idea of how much of an impact the energy prices have been and the energy complex, you can see right here, high yield spreads. This is, the gray is high yield X energy and metals. So yeah, they've increased over the last call it 6 months, but not nearly as much as the high yield energy prices, or I'm sorry, the high yield energy spreads have. So you can see that the combination of the two is the full spread here, and a lot of that has to do with the energy sector. So you want to make sure that you're careful with your high yield bonds. Will 2016 bring us a recession? So this is the slide that I was talking about that we left in there from last quarter. You know, it was hard to say that we weren't going to go through a recession in 2016. Earlier this year, January 25th, when we had the worst January we've seen in decades. But we sat here on this call and said we don't think we're going to have a recession. And the reason is some of the same reasons that we're talking about why we think that there's still some positive things in the future. You know, every time we've had a recession, one of these 3 things has happened: a commodity spike, an aggressive Fed, or extreme valuations. So let's go through these. A commodity spike. Do we have a commodity spike? We do not have a commodity spike. Commodity prices are 2 standard deviations below their 10-year average. So if anything, we have a reverse of a commodity spike. Aggressive Fed. Well, let's see. We have a Fed funds rate that's at 0.25% right now. I don't think that constitutes an aggressive Fed. So I'm going to check the box no on commodity spike. I'm going to check the box no on aggressive Fed. Extreme valuations. I don't think we have extreme valuations. Valuations are getting stretched a bit. We're nowhere. We're about average for valuations. I can make a very good argument that in today's low interest rate environment, valuations should be a lot higher than they have been in history. When we have a 10-year treasury that's yielding 1.8% and an S&P 500 that has a dividend yield of 2.3%, and I'm looking over a 10-year period, I can make a case for in an environment like that where you're going to have a higher than normal PE multiple on the S&P when its dividend yield is higher than the 10-year treasury. So extreme valuations, I'm going to check the box no on that one as well. So none of those 3 things have happened. We don't believe that that we're going to see a recession, especially since we really haven't had the growth to the overheating that would constitute us having the ability to go into a recession. Now, the first quarter is going to be pretty close if they revise the numbers downward at all. 0.5%, very, very close to a negative number there. So if we have two negative numbers in a row, that constitutes a recession. So we're not out of the woods just yet, but we definitely think that we're heading in the right direction versus where we were in January. So how to navigate this type of an environment? Low interest rates. What do we need to be doing? Well, what we can't be doing is sitting on cash, and that's what a lot of people are doing. So if you look at the M2 money supply as a percentage of nominal GDP, you can see this goes back to late 70s, and the average M2 supply, M2, you can think of it as the M2 is basically what institutions, what investors, what is in cash, what companies have in cash. And so they have 68.4% of nominal GDP in cash. And you can see this number just skyrocketed over the last recession. And people just, they're okay piling away cash and earning, a 6-month CD, earning $370 in interest on a $100,000 6-month CD. So you're getting paid nothing, but people are okay with it because they keep their money. It's staying stable. Well, at some point, investors are going to, they're going to have to earn a return on their money. They've got some kind of goal, and they're going to be behind the goal if they just stick their money in cash. So that cash is going to go somewhere, and when it does, that's going to be a tailwind for asset prices. So where is that cash going to go? Is it going to go into bonds that are yielding, 1.8% on a 10-year Treasury? Probably not. Where we see money flowing these days is, people saying, well, I'm not getting a very good return in my bond portfolio, so I'm going to reach out on the risk spectrum, and I'm going to go to high yield bonds, or I'm going to go to preferred stock. And it acts like a bond, doesn't it? See, aren't preferred stocks, they give me a good 5% dividend yield, and yes, they do, but they are not bond replacements. They, if we have a slowdown, will get hit more like a stock than like a bond. So we need to be very careful of reaching for yield. You get paid for the risk that you take. If a company is giving you 5 or 7 or 10%, there's a reason that they're giving you 5 or 7 or 10%. So we see money going into areas like that. Real estate, REITs, it's driven those rates down because people pile into them and their valuations go through the roof. And so we're starting to see some of that. But then money is also going to go into stocks, in our estimation. Right now, if we look at this, the S&P 500 expected returns based on forward PE, this green line is the predicted, based on what the current PE is, predicted return of the S&P 500 over the next 5 years, annualized. So what this is telling us is this benchmark here is predicting 11.2% return from the S&P over the next 5 years. The gray line is the actual realized 5-year forward annualized return. So it's 5 years behind, and so you can see that it doesn't always move exactly the same, but it's a decent trigger or a decent predictor of what returns are going to be. Maybe they're not going to be 11.2, but maybe they're going to be half that, 5%. Well, that's a lot better than a 10-year bond that's earning 1.8%. So this is one area that we think will have some inflows. It is stocks, and we're looking at domestic here, but we want to make sure that we also look at international, and we'll get to that here in a second too. I talked about commodities prices. being 2 standard deviations away from their 10-year averages. So you can see here's our distribution of prices for these commodities. The only reason I added this to blocking and tackling is we want to make sure that we have commodities in the portfolio. It's an alternative asset class. It has not done well over the last 4 years. But guess what the best performing asset class is this year? Commodities, up almost 10%. So it just gives us another asset class that will hopefully give us a decent return over time, but also just gives us that rebalancing, that divergence. You know, when things are zigging, other things are zagging. It's not correlated to the rest of the portfolio. So these things are good pieces to add to the portfolio. We also want to invest internationally. And I added this slide last time, and I revisited this. I did a presentation yesterday, and everyone was floored by this slide. And I just think it's a really good slide to show bias. So we've got global GDP. U.S. makes up 22% of global GDP. The rest of the world, 78%. The U.S. makes up 36% of the global stock and bond markets. The rest of the world, 64%. The average U.S. investor allocation, 74% in U.S., 26% global. Okay, so there's a bias there. It's a U.S. bias, even though there are more assets and more GDP growth outside the United States. I should say not GDP growth, but just GDP. Okay, so what is he trying to say here? Let's take a look at the biases that are within our own country that we could probably figure out, you know, what's going on here. If I'm looking at financials and I'm looking at folks in the United States who have an overweight versus the national average in financials, guess where it is? It's on the East Coast. The East Coast has 9% overweight to financials. Why? Probably because a lot of financial companies, their home offices are back east. People know financial companies back east, so they like to, they know them, it's familiar, so they have a financials bias. Technology, 10% out west, Silicon Valley. Technology, folks in Silicon Valley and in the West, they have a familiarity with technology, and they have a 10% overweight compared to the national average in their portfolio. Energy, South, 14%. Industrials, Midwest, plus 11%. I think you guys understand what I'm trying to get at here. There is a bias, and the bias is toward U.S. investments. And over the last 5 years, the U.S. has definitely been the place to be, especially large cap U.S. But that's not always the case. And we want to make sure that we have other pieces of our portfolio that might be zigging when the U.S. is zagging. And then to take it a step further, if we look at valuation metrics, here's the U.S. I would say fairly valued, a little bit overvalued. You're at 16.6 versus an average of 16. Now, once again, I'm going to make the comment, in a low interest rate environment, we can make the argument that these numbers are okay to be higher than the average because we're in such a low interest rate environment. Developed international, PE multiples in line with where they have been. Once again, low interest rates could constitute higher multiples. Emerging markets, and this is where, you know, we see the biggest opportunity along with the most volatility. They go hand in hand. Average, now this is price book, so it's a little bit different than price to earnings. But price to book, average has been 1.8. The current is 1.3. So there's a lot of opportunity here in the emerging markets from a historical perspective. and from valuation. So what's priced in? Well, a lot of negative news is priced into emerging markets. So if they improve, there can be a lot of positive returns in those areas. A little bit more diversification, beneficial. If we were to look at the recession and look at an all-equity portfolio, you dropped 50% all in the S&P 500. So we want to make sure that we have bonds in the portfolio. We don't know what's going to happen tomorrow. We don't know what's going to happen next year. Even though bonds are not giving us a very good return, if the economy turns south, and no matter what anybody tells you, it's very, very difficult to know this before it happens. If the economy turns south, bonds still will do fairly well in an environment like that. And when I say fairly well, I mean they might earn 2 or 3%, but that's better than your equities that might lose 25%. So you need to make sure you have fixed income in the portfolio. Even if we don't like fixed income where it is now, it's just going to stabilize your returns. And if we go through a period of disruption, you've got a lot better chance of recovering a lot quicker with more fixed income in your portfolio. You can see a 40-60, 40 aggressive, 60 fixed income recovered. So the bottom of the market was March 2009. Basically, we recovered in the same year. We recovered 7 months later, a 40-60 portfolio. A 60-40 portfolio a year later. All S&P didn't recover until March 2012. So that's a lot of time to be underwater from the 2007 peak. That's, 4.5 years. The S&P 500 portfolio didn't get back up until just recently, and now it's still, you're not giving up a lot. If you're super aggressive, in up times you're going to give up some, but in down times you're not going to be harmed as much either. So you want to make sure that you have the right portfolio for your situation. Now, if we bring it all together and we say, okay, let's just look at asset classes by themselves: emerging markets, developed international, small cap, S&P 500, and then a combination of all of them. So the blue line here is volatility, average annual volatility. The higher, the more volatile. The gray is annualized excess return. The purple is what we like to call the Sharpe ratio, which is for every unit of risk you're taking, what is the incremental return you're getting? So emerging markets, you want a higher Sharpe ratios mean you're getting paid the most for every incremental amount of risk that you're taking. So emerging markets have not paid off since 1994 to 2015 for the risk. You just haven't been paid for the risk that comes with it. Developed, a little bit better. Small cap, a lot better. Large cap domestic, pretty dang good. But then if you combine these all together, you actually get a Sharpe ratio that's higher than all of them. And that's because of the correlation of these asset classes. They're not correlated one for one. There is a reduction of risk when you add non-correlated assets. And that's exactly what we do with the portfolio. Our goal is to get the highest Sharpe ratio we can with the asset classes that we have. Now, the last 10 years, this is what annualized returns have been versus annualized volatility. So ultimately, you'd like to be as far up as possible and as far left as possible. But you can see, for the most part, the more risk you take, the higher the return. Now, there are a couple of outliers. MLPs, private equity are kind of the outliers. You're getting paid a lot more for the risk that you're taking. But for the most part, we see this efficient frontier line. You're getting paid. The more risk you go, the more return you're getting. Now, the problem is we don't know what the next 10 years is going to bring. commodities being way down here, negative return over the last 10 years with a whole bunch of volatility, probably not going to happen over the next 10 years with the 10 years that it's just gone through. And that tends to happen. And so we don't know what the next 10 years are going to bring. We have those assumptions in the portfolio, and that's why we overweight certain things versus underweight certain things. But that is bringing it all together, looking at the portfolio frontier, the efficient frontier would be combining all of these so that we get a portfolio that is on this efficient frontier, which is getting the highest rate of return for the given level of risk that we're taking. And then we also want to make sure that everybody realizes that markets are volatile. Despite average intra-year drops of 14.2%. So on average, any given year, if you look at all of these years, at some point in the year, the S&P 500 is going to pull back 14.2%. So that's a scary proposition. You start trying to time the market and you pick the wrong time and you get a 14.2% drop, and then you can't handle it and you sell, and then you end up recovering all of that and ending up positive. The first part of this year, we had an 11% pullback. We're up 1%. We were at the end of March. We're roughly right around there, maybe flat for the year. But if that 11% would have scared you and you would have sold at an inopportune time, you would have missed the 12% to get back up to positive 1. And so you start to look at these intra-year drops, and you can see there's a lot of volatility. The stock market is volatile. That is why you get paid higher returns for putting your money at risk. There's no easy way to double your portfolio in 10 years. You have to take risks. You have to put yourself at the availability of losing money in order to make money. And once again, this just shows, if somebody would have thought that one of these pullbacks, was another recession, well, they would have missed a pretty dang good run afterward. And so we're looking at about 2 years now where we've been flat. That happens in the market when we look at long-term returns. You go through 2-year periods where equities don't do all that well, and there's some volatility in there. But then you go through periods of time where you jump way up, and then you go through periods of time where you're kind of flat again. And so the past 2 years has kind of put in a new starting point for us, which will give us the ability to jump off that starting point and go to higher levels. I've talked about this in the past. Basically, we just want to make sure that we have the right time frame. If we've got a 1-year time frame, we can't be in the equity market. We don't know what it's going to do. Best year in the S&P has been up 47%. Worst year down 40. So it's a crapshoot. We can't tell you. Bond market still, it's big distributions. -8. Well, if you're in the market for 1 year, we don't want you to lose 8%, and then you need that money. So bonds and stocks or a 50-50 portfolio, we shouldn't be talking about those things if we've got a 1-year time horizon. If we've got a 5-year time horizon, well, now we can start talking about a combination. A 50-50 portfolio over 5-year rolling from 1950 to through 2015, never lost money. I like those odds. Doesn't mean it can't happen in the future, but since 1950, we've never lost money in a 50-50 portfolio over a 5-year period of time. If we take this out to 10 years, now we can start talking stocks, because now the worst case 10-year period has been -1%. The best case is 19% annualized. Well, you're going to double your money close to twice over that period of time if you're getting 19%. And then bonds and a 50-50 portfolio, you're looking pretty good. 20-year, now we really can talk stocks. Your worst case is 7% over a 20-year period. So what does this mean? Well, if we look at this and we say, okay, well, the worst period for the S&P 500 over 20 years has been 7%, Well, 15 years, not 20, but 15 years, the S&P is at 4.1%. So there's a dislocation here. Either this number is going to get lower here in a couple of years, or we're going to have some decent returns in the S&P 500 that's going to make this 4.1% annualized return higher than 4.1. I also wanted to bring up that large cap U.S. stocks, although they've done really well over the last 5 years, doesn't mean we need to put all of the portfolio in large cap U.S. stocks. Doesn't mean we should be comparing the portfolio to large cap U.S. stocks. It could have been, you know, if we would have looked at the time between 2000 and 2010, large cap stocks did not make money. They were flat over that 10-year period of time, domestic large cap stocks. That's why we want to have REITs in the portfolio, high yield, small cap, emerging markets, developed international. We want to have all of these things so that we can get to this asset allocation portfolio, which is, you know, never at the top, never at the bottom. It's always near the middle, and it smooths out your ride. And 5.7% in a portfolio over 15 years, although it's, you know, not the greatest numbers we've seen, it's not horrible either. And with a lot less volatility. We've got 11.2% standard deviation here at 5.7% return. So you're getting paid for the return at a very high level for the risk that you're taking. And then the other thing I wanted to point out is commodities. You know, 4 years, 5 years, one of the worst performers. Go figure. Year to date, up 9% thus far. So it's not uncommon that the things that are at the bottom one year are at the top another year. They're just volatile. That's why we don't own 100% of anything in the portfolio, because we want to put these together in a mindful way so we can keep you in the middle here and still get a decent return. So with that, our overweight and underweights have actually not changed since last quarter. You know, we've had a little bit of improvement in some of these areas. Hard currencies, dollar has gone down, so this was definitely benefited over the last quarter. Commodities, you already know what happened there, benefited over the quarter. Emerging markets benefited over the quarter. Fixed income, long duration underweight, rates went down a little bit or stayed about the same, so no impact there. Domestic equities did worse than international. International did a little bit better, especially when you look at emerging markets. REITs did okay during this period of time. Utilities did not do well over the first quarter. They've done well in May and in April, but some of these areas, we still see these two areas as people reaching for yield, and we think that there is that they're artificially overvalued. So we're a little cautious on those areas. So with that, I'll take any questions. Nick, if you would go ahead and queue up the questions for us.
Okay, to the meeting attendees, feel free to insert and type any questions that you may have in the chat box that is attached to your GoToWebinar panel, and we'll take a few moments to address any of those at this time. Okay, well, if anybody does have any questions that they think of in the short term here, feel free to send us an email as always. And I guess I'll turn it back over to Sean for any concluding remarks. Thanks everyone for joining us, of course. And we certainly look forward to seeing you for the third quarter Market Insight webinar for 2016.
I appreciate everyone spending their Cinco de Mayo holiday with us today. Now maybe you can go enjoy a shot of tequila or something like that. So we'll let everybody get back to their daily lives here, and we'll talk with everybody next quarter. Take care.